anything can happen in markets. I mean, anything can happen in markets, and that's why I say don't ever borrow money against securities. That markets don't have to open tomorrow. I mean, you can have extraordinary events.
So how much cash should an ordinary investor have on a percentage basis, do you think?
It depends on their personal situation. I mean, if you're working in something where you're living off your paycheck from week to week, you want to have a little cash around, and you certainly don't want to have a credit card that's maxed out or anything like that. But if your house is paid off, if you don't have big living expenses, you got a portfolio of decent, diversified businesses, you don't really need any cash. I've got responsibility. We've got insurance claims. We could have hurricanes that, would happen. All kinds of things where we might have to pay out billions of dollars. And I've got over 1 million people that own shares that are counting on me to run the place so we get through periods like that. But if I were retired, I had say $1 million portfolio of stocks that was paying me $30,000 a year in dividends or something of the sort, and my children were growing, the house was paid off and everything. But, I wouldn't worry too much about having a lot of cash around.
That worked the last 77 years, but there's a question that came in, T29. This is from Scott Baker. With so many people in the S&P index funds, is it still market neutral and the best investment vehicle for most people?
Yeah, I think it's the best investment because most people don't know how to pick stocks, and most of the time I don't know how to pick stocks. I mean, it's not an easy game, and by definition, people are going to do average. I mean, take everybody in aggregate, and if half of them are paying big fees and jumping around and paying brokerage commissions, the other half have to do better. But if you'd been a pension fund and you put $1 million into the S&P 500 at that time and reinvested it, during my investing lifetime, that million would have turned into 5.3 billion. You would have gotten, for every dollar you put in, you've gotten over $5,000 without ever reading a headline, an annual report. You didn't have to know accounting. You just had to believe in America. And you didn't have to pick the right stock. You just picked America. I go back and I point out that there were two 77-year periods before that, and that takes us back to George Washington getting inaugurated. And there wasn't anything here then. And now you have $108 trillion of household wealth in the United States. We've got something that works. And that framework wasn't that we were working harder, it wasn't that we were smarter, but we had a framework that unleashed human potential. And just think of that, 3 77-year periods, one of which I experienced, and you couldn't help, but all you had to do was believe in America. I think the earned income tax credit is the best way to put money in the pockets of people that don't fit well into the market system, but that are perfectly decent citizens and that have made a good bit of the success somebody like I've had with Berkshire or something possible. It wouldn't have happened without the America we have. And if you go back 200 years, and we're all working on, 80% of us are working on farms. The person that's the best at that, working on that farm, whatever it may be, is worth maybe twice the ones that's the worst. I mean, that's the difference between super talent and no talent in the farm economy, picking cotton or whatever it may be. Now, if you're the best middleweight fighter in the world, you may get $20 or $30 million. And if you are just a good citizen, raise nice kids, help in the neighborhood and everything else, but you don't have market-related skills, you'd be good on that farm still. And you would be earning something comparable to most of the people around you. But you don't have something now that, as it gets more and more specialized, and it's going to continue to get more specialized, you want two things for that person. You want them to have a decent life. I mean, they live in a country with 60,000 of GDP per person. You want them to have a decent life, and they can. I also think you want them to have a feeling of accomplishment. So you want them to have a job, assuming that they're not handicapped in some way. You want them to have a job. But the minimum wage would be one way to say, well, we'll make sure that they have enough money in their pocket. But that's got a lot of effects in disturbing the market system. They just need more cash. they don't need a higher wage. They need more cash in their pocket. And the government, at a relatively low cost, can provide a decent living for anybody that's working 40 hours a week and has a couple of children. And we've gone in that direction, and it's sort of bipartisan. I mean, you find both Republicans and Democrats for it. I think it would be better not to have one annual payment, that they get it monthly. And I think there's various things you could do, but you want them to feel part of the system, and you want to have them get, as more and more of these golden eggs are laid, you want them to get a little more of their share.
You talked about this in the annual letter over the weekend, and just even at the top of the show, where when you look around for a business that you want to buy, you can't find any at attractive levels. However, when you're looking at equities, you do see that as a good place. That Berkshire has been a net purchaser of equities this year in 2018, and that's because you like the deals that you're getting in the market.
You can buy small pieces of businesses for less than you can buy whole pieces of businesses.
For the premium you'd have to pay if you were buying the whole thing.
Yeah, so you get a bargain as an investor compared to what I can get in terms of buying the whole business. And people, if they just think of stocks as pieces of business, they'd be so much better off than thinking of them as little things that move around in price. And I think with Berkshire, we have an unusual number of people as shareholders who just look at Berkshire as a business. They look at it as a savings account. They put some money in 20 or 30 or 40 years ago. We retain it and reinvest for them, but we're their savings account. And that's the way I look at my own stock. If you own stocks like you'd own a farm or an apartment house, you don't get a quote on those every day or every week or anything. You look at the business, and the value of American business depends on how much it delivers in cash to its owners over between now and Judgment Day, and I don't think it changes in 10% in a 2-month period if you're looking at it as a business. Now you've got anything can happen in markets. I mean, anything can happen in markets, and that's why they don't ever borrow money against securities. That markets don't have to open tomorrow. I mean, you can have extraordinary events. So I think to some extent you can get some of the instruments that people don't understand very well that have a lot of firepower in them.
Like
and
the volatility index and things that are tied to that.
The idea of people taking a position, and they're gambling. They're not investing. Nobody's investing when they buy, some supercharged index on how the VIX does or something like that. They don't need it in their life. It's an unnecessary instrument. Now, they will create instruments that the public will buy, and you can just count on that. Wall Street's been doing that since they met under the Buttonwood tree in 1792 or whatever it was on the exchange. If you're investing, if I'm going to buy a half interest in a McDonald's stand and you're going to run it, or a McDonald's franchise and you're going to run it, I look to the business to determine whether I've made a good investment. And I'm concerned about whether we have new competition, how we do over the years. But it's the business I look at. When you're just looking at the price of something, you're not investing. I mean, if you buy something, Bitcoin, for example, or some cryptocurrency, you're not looking to the asset itself to produce anything. If you buy an apartment house, you're looking at how the apartment house does. If you buy a farm, you're looking at the farm does. If you buy a whole business, you're looking at how the business does. If you buy a part of a business, why shouldn't you look at how the business is going to do? But people get charmed by lots of action and the fact that things are liquid and all of that. And it does have repercussions back into the market when you get something like an ETN arrangement on the supercharged on the VIX. I mean, where you can lose 90% of your money in one day. I mean, that really doesn't belong with the word investment. You buy a 30-year government bond, it has a whole bunch of coupons attached. In the old days it does, now it's electronic, but it has a whole bunch of coupons, and the coupon says 3% or whatever it may say, and that's what you're going to get between now and 30 years from now, and then they're going to give you the money back. What is a stock? A stock is the same sort of thing. It has a bunch of coupons. It's just they haven't printed the numbers on them yet, and it's your job as an investor to print those numbers on. If those numbers say 10%, and most American businesses earn over 10% on tangible equity. If they say 10%, that bond is worth a hell of a lot more money than a bond that says 3% on it. But if that government bond goes to 10%, it changes the value of this equity bond that, in effect, you're buying. You are buying, when you buy an interest in General Motors or Berkshire Hathaway or anything, you are buying something that over time is going to return cash to you. Maybe a long time in terms of Berkshire, but it'll be bigger numbers. And those are the coupons. And it's up to you, your job as an investor, to decide what you think those coupons will be, because that's what you're buying, and you're buying the discounted value. And the higher the yardstick goes, and the yardstick is government bonds, the less attractive these other bonds look. And that's just fundamental economics. So in 1982 or 3, when the long government bond got to 15%, a company that was earning 15% on equity was worth no more than book value under those circumstances, because you could buy a 30-year strip of bonds and guarantee yourself for 15% a year. And a business that earned 12% was a subpar business then. But a business that earns 12% when the government bond is 3% is one hell of a business now, and that's why they sell for very fancy prices. Some people should not own stocks at all because they just get too upset with price fluctuations. If you're going to do dumb things because your stock goes down, you shouldn't own a stock at all. No, I mean,
what are dumb things? Selling a stock?
Yeah, selling a stock because it goes down. I mean, if you buy your house at $20,000 and somebody comes along the next day and says, "I'll pay you 15," you don't sell it because the quote's 15. You look at the house or whatever it may be. But some people are not actually emotionally or psychologically fit to own stocks. But I think more of them would be if you get educated on what you're really buying, which is part of a business. And the longer you hold stocks, the less risky they become. Whereas the longer the maturity of a bond, the more risky it becomes. It's not easy psychologically for many people. But I've been teaching since I was 21. I taught my first class on investments, and I had a class last week with 11 schools, 220 students, and some of them get it and some of them don't. People would rather gamble. I mean, the idea that you can double your money in 6 months, that's just going to, it's why people go to the races, why they go to Vegas, whatever it may be. They even know the odds are against them, and they still do it. I mean, it's a strong instinct to want to get rich fast, and I don't know how to do it.